Today I will tell you the absolute #1 rule of trading. Without this rule, don't even bother starting. And the best part is, this isn't some fancy indicator or some random hot stock you should trade. This is a fundamental principle that separates the losers from the winners. And why is this rule so crucial? This rule makes sure you keep your head in the game, how to protect your hard-earned cash and keep your emotions in check. Let's face it, it is very easy to let fear, greed cloud your judgment. And this leads to dangerous situations. Let me ask you this question. Would you jump into a swimming pool if you do not know the depth of the water? Absolutely not. And the same is true for trading. If you do not know your risk, you're just taking a blind leap, and this can leave you financially wounded. But there's great news. Risk management doesn't have to be complicated. I will give you the exact risk management indicator I use. It all comes down to this: protect your capital. It doesn't even matter if you win or lose today, and it even matter if you win or lose this week or this month. Every single trade is one of 1,000 trades, so you need to be able to come back and come back and come back again. But there is another amazing advantage, and that is the psychology behind risk management. Because you might think that risk management is all about the numbers and the statistics, but that is not true. When you know how much you will lose, when you limit your losses, you can approach every time, every new trade in the market with a clear head. Because every trade is one of 1,000. The biggest enemy of profits is emotionally decision making. And without risk management, every trade becomes this big gamble, and then fear starts to creep in. And then when your position goes against you, what will you do? So in order to do that, before you enter a single trade, you should know where to get out. When you're trading, different stocks have different volatility levels, and depending on how volatile a stock is, you need to change your position size. A stock that on average moves very little needs a very big position size, and a stock that can move a lot needs to have a way smaller position size. But then the real question is, how much should you risk for every single trade? Now, I don't like to risk more than 1% of my day trading portfolio. So if you have a portfolio of $10,000, then you should not risk for any single trade more than $100. Now, volatility decides how many shares you can buy. If you want to risk 5 cents, then you can buy 2,000 shares. If you want to risk 10 cents, you can buy 1,000 shares. If you want to risk 20 cents, you can buy 500 shares, 50 cents to 100 shares, and $1 100 shares. But then the question is, how can we see fast how many shares we want to risk? Here is where my favorite risk management indicator comes into play, and that is the ATR. This is the average true range. ATR calculates the average candle size over the past X candles. Say we have an ATR on the 1 minute chart, and that calculates the past 20 candles. Then here will the ATR give us the number on the average size of the past candles. I use the number of the ATR to calculate my position size. So let's say the ATR gives a number of 8 cents. Then I know I can risk 10 cents, then I buy 1,000 shares. One thing to note here, which is very important, that it all depends on the time frame you use and the strategy you use. But there's one thing for certain: if you work with an ATR to calculate your position size, it's way faster to calculate your position size. It is way more efficient to know immediately how big your share size can be. So when you know your ATR, you can calculate your stop loss level, and obviously where you automatically will exit the trade. Now, I like to do it with one ATR, but keep in mind, one ATR can give you very tight stop loss levels. It's also possible that it will unnecessary get triggered. If you are more confident in bigger stop loss levels, you can calculate it based on 2 ATR. Remember this, successful trading isn't about winning every single trade. It's about managing your risk and preserving your capital. By following rule number 1, risk management, don't risk more than 1% for each single trade and use the ATR to calculate your position size. You will be on your way to make smarter decisions and achieve long-term success. And if you truly want that long-term success in the market, you have to check out this video. You can't miss this, because now you know rule number 1, that is managing your risk. But here I give you 20 more important rules. Check them out. Do it!